the bad thing on the Social Security benefits being taxable is that money's never been indexed for inflation. So, the amount they're taxing in 1983 has not been indexed for inflation in 2024 terms.
And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning here on the radio and for you in person, personally, your resource for financial, investment, and retirement guidance. He is Chris McIntire of McIntire Retirement Services. And we always appreciate him being a resource to us here on the program, providing that proactive guidance and insight and information on your money, what you need to be doing or thinking about with it. And Chris, really, one major topic, I think, on the minds of every American, the American public in general right now, but certainly for proactive savers and investors, and that is this upcoming election and what impacts it is going to have on our wallet and our portfolio, and then the outlook for retirement.
Yeah, absolutely, buddy. And it's one of the key factors in many conversations I have with clients. It's like, well, should we, get out of the market ahead of the election? And it depends on where your political point of view is, right? I mean, if you're a Republican and you think the Democrat may win, then, that's overwhelmingly been people concerned about taxation and regulation, right? Because, I think the Democratic nominee has talked about, I'm trying to stay neutral here, Peter. So
yeah. Well, regardless of whatever side you're on, Chris, the idea that the other one could be in power is sort of scary. And then when you think about what impact that could have on your money and your finances with the kind of different taxes that have been proposed, that becomes an even more compounding, fearful kind of factor there. But Chris, if you look at the stats and who is in the White House versus the performance of the market, it's not necessarily who is in power or what party occupies the White House that determines or dictates the direction of the market. Maybe this is a little bit of a chicken and egg scenario, but the presidential approval rating far, far more seems to match or correlate the direction of the market. When there's a positive approval rating, the market's generally moving in a positive direction. When there's a negative approval rating, the market more often than not follows and moves negative. So I don't know if it's that the approval rating dictates the direction of the market, or again, chicken and the egg, the direction of the market then generates the kind of approval rating that we're having for the president, but they do seem to be correlated that way.
Yeah, you're absolutely right. And I was just having a conversation with clients about this, and, some long-term clients that we know political affiliations, and, I mean, we're at the point now where a Kennedy is backing a Republican candidate. So, I mean, are the parties today the parties they were 30 years ago? And I would probably say probably not. Most people would think, the Democratic Party has moved to the left, the Republican Party maybe moved to the right, and where did the center go? Because it's the moderates that make things happen, right? I mean, I think most of us are fairly moderate in the overall picture. We want low taxes, less government involvement. Don't think anybody wants to vote to have their taxes raised. Just look at how the troubles that schools have, in raising revenue, because nobody votes to raise their taxes. And you have, one of the candidates running right now is talking about taxing unrealized gains for somebody, Now, to be fair, all that has to come through the House of Representatives. So the stock market and the investors typically like a divided House like we have right now. Republicans run the House, Democrats have the Senate by, one vote, but also have the presidency, and markets are at, have been at record highs at some point in the year, give or take the volatility here that we typically find in the third quarter. But investors like, I think the checks and balances fare well for investors, because when one party has all three branches of government, the Senate, the House, and the presidency, things can get skewed. And in the Senate, you got to have 60 votes to do anything really meaningful. So now and I'll say this probably since, President Obama, President Trump, and also the current administration, President Biden, they do a lot of ruling by executive order versus legislation. And I think businesses and whatnot would much rather see legislation than executive orders, because the next administration come in, the Keystone Pipeline's a perfect example.
However, that
That's
takes some compromise, Chris,
yeah,
which does not seem to happen, right? And
yeah,
we'll actually be talking about why there is reason for concern that that will not happen in just a few short years, and what impact that will have on your wallet. Today on the program, going to be talking about Washington and your retirement, and then 4 key risks to watch for. And ladies and gentlemen, if you're worried about your retirement in general, the risks that you're taking, the fees that you're paying, the taxes you may be liable for, that's certainly one we'll touch on. But in particular, what the direction in Washington and politics may impact on your planning. You should talk with somebody and plan proactively. And that's what Chris McIntire is here for. Again, your local personal resource, and so many proactive savers and investors across Northwestern Ohio have utilized the services of Chris and the team from McIntire Retirement Services. So many more need to. And that's why, again, we are here on the program each week. But the true value of the program is that Chris is a resource that you can talk to personally. All you need to do is pick up the phone, have a conversation, and if merited, set up a time for a complimentary review of your comprehensive, holistic plan. He'll look at income, investments, taxes, healthcare, legacy, map out a roadmap, your game plan for retirement. 800-868-1194, 800-868-1194. 800-868-1194. Chris, to your point about the majority of the country probably being moderate, right? The news is always going to be a little bit more divisive. The headlines of the news being divisive is the very fact that draws, I think, viewership, listenership, and therefore advertising revenue. The extreme wings, therefore, get most of the attention, where I believe you're right. Like, most of the country is moderate, just like most of the country would fall into the category of middle class. And that's really who bears the brunt of the risks that we're going to talk about today. The ultra wealthy, they plan around it. There's very few of them, and they may plan in a different way. And then, of course, the those that have not saved at all and don't have the means to, not going to be impacted greatly by tax law changes. Regardless, it's the middle class that needs to worry about these risks that we will talk about, in how Washington can impact our retirement. Retirement can be full of risks anyway, right, Chris? And then when you look at unpredictable stock markets, fluctuating interest rates, compounded by the fact that most Americans have not addressed the most important and impactful risk to their retirement, the amount of income they can actually spend in retirement, and how legislation and taxes can impact that.
sure. Yeah, I had a client in here just recently when we were talking, and he said, my monthly withdrawals had been meeting everything, for our retirement. He said, and now I'm $200 to $300 a month short because of the impact on inflation. I mean, he ran his numbers very tightly. So, and so that's your average retiree, probably a nice moderate, perspective on the political landscape, so a real true middle-class American, inflation really affects people that are middle class and lower than that, right? Because if the cost of gas goes up, 15%, that doesn't affect somebody
True.
making $1 million a year. They don't pay any attention what the price of gas is. They don't, worry about driving 4 extra miles to go to Costco to save a dime on a gallon of gas. It doesn't make any difference to them, but when the cost of goods and services go up, that really affects the lower class. So you can talk about, we're only going to tax the rich, right? Well, guess what? They already pay all the taxes anyway. So if you're going to do a tax increase, guess who's going to pay it? The people that already do. Okay? And if you're going to cut taxes, who's going to benefit from that? Probably the people that actually pay the taxes. Okay. And, you and I had a conversation before we aired here, what we're we're not necessarily right at the middle class line, but you know, the amount that we pay in taxes, it just is ungodly because we're self-employed. We have to physically write the checks to send in. Most people don't really pay much attention to it because it comes out of their check and they've been pre-programmed to accept it.
Chris, you talk about that fact often, the fact that you are a business owner yourself and therefore understand the challenges of business owners. And it's been said as long as I can remember that small businesses are the engine of the American economy. So if a small business owner is listening and is thinking about their own financial situation, not only the management, the growth, the cash flow, the expenses, the taxes of their business, but planning for their own retirement as well, would you say that that gives you a unique perspective and insight into being able to have an informed conversation, informative conversation, in helping them understand and address those challenges?
Yes, yeah, absolutely, Peter. And you know, and we pay $2,110 a month for health insurance, you know, so you know, I can relate to all of that. I know what the cost of utilities are. I have 3 offices. So, you know, my wife says, God, look at the electric bill at the Port Clinton office, which is the smallest one we have square footage wise. And, you know, and times that by 3, you know, when these things go up, our property values just went up like 60% where I live. So all our property taxes are going to go up. And I'll bet they don't cut property taxes because our value of our homes went up as well, right? They're rolling in the coffer. So, you know, you're getting me up on my soapbox here, but you know, I am certainly one that would favor, the private sector running things more so than the government, because you know, our economy is 75% driven by consumers, 25% driven by government spending, right? Military and things like that, highways and all of that, you know. And obviously you can't eliminate that to zero. That's not my point here. But, you know, where is that fine line in balance where the government says, hey, we have a bigger appetite for spending, so we need more of your efforts, you know? And, you know, we got one of the candidates running for president is talking about taxing unrealized capital gains. So what that says is we want you to pay taxes on money you have not earned yet.
Yeah, we'll definitely be talking about that proposal or about that conversation and what that really means, how that would impact savers and investors. Again, ladies and gentlemen, if you've got questions, if you would like to sit down for a comprehensive review or a detailed strategy and tactical session and conversation with Chris McIntire, pick up the phone, give a call, 800-868-1194, 800-868-1194. Chris, you spoke about the language of the proposed tax changes and how it has been talked about only in the aspect of taxing the rich or the ultra wealthy or only those high income upper class kind of earners. But in reality, the current tax laws and code that we have on the books today, if nothing else is done, in just 2 short tax years away, January 1, 2026, if nothing is done, taxes are slated to increase across the board. And this is even on the 12%, one of the lowest tax brackets, moving up to 15%. That's a 25% increase for those dollars for even average income earners. And then across the first $200,000 of income that the average married couple would earn, it's about an 18% higher tax increase. And that's if nothing is done. And in order for something to be done, to your earlier point about compromise and agreement, Chris, a new legislation would have to pass the House, the Senate, and be approved by the president. And I feel that that will be a difficult task to accomplish so that these taxes don't go up.
Yeah, absolutely. And I've got a 2024 tax information piece here I'm holding up for those who might look at our podcast. So there's $71,000 right now of income that's in the 12% tax bracket right now. Okay. If it goes up to 15%, that's a 3% increase. That is $2,130 more in taxes that middle America will pay. That one of the candidates is running on says we need to get rid of those tax cuts it's adding too much money to the deficit, because God forbid they spend anything less. They think they need to take more from other people. That stuff, that drives me crazy. That's a middle class tax increase. So if they say they're only going to tax the rich, when those tax cuts expire, they're hitting the middle class. It's $2,130 a year. Yep.
And Chris, at the same time, simultaneously, these elevated standard deductions could go away, right?
Absolutely. And I just think that money is much better off in the people who's earned its hands than the people who did not earn it, because we have to be fiscally responsible with our dollars, and they are very fiscally irresponsible. And I'm blaming both political parties on that, because our deficit has ballooned under both Democrats and Republicans as well.
So again, Chris, that 12% tax bracket for married couple goes up to about $94,000. There are some dollars that fall under that, but for those $71,000 that fall into that bracket currently, that is about $8,520 that you owe in taxes on that income. And as tax laws stand today on the books, January 1st of 2026, that portion of your taxes, that bill will rise to $10,650. That is a $2,130 higher bill. Again, that's a 25% higher bill on those dollars. So we are talking today about Washington and your retirement, 4 risks to watch for. And certainly, Chris, this falls under tax risk and legislative risk. That's the 2 main topics that we will talk about. Tax risk has to do with the level of taxation, the amount that you pay in taxes. This is the risk that your taxes could be or will be higher in retirement than you planned or understood or assumed, meaning more of your income will go to the IRS. And that's exactly what is on the books and in store for people if we are not proactive in planning and managing that tax bill, which I know you spend a lot of time doing.
Yeah, and the impact of inflation affects the government spending side as well, because everything they buy costs more as well, and they get that money from us. So, part of this frenzy here that you and I have been talking about here today, is a self-fulfilling prophecy, right? During the COVID times, they were throwing money at people. Okay, prices went up. Okay, and now all of a sudden they're, everybody's struggling to make ends meet. And they're like, well, let's raise your taxes then, and put even less money in your pocket. So inflation is created at out of the Federal Reserve and the government spending, basically, right? That's, Whirlpool in Clyde, Ohio here doesn't manufacture inflation. They manufacture washing machines. Those washing machines take parts. Those parts cost money. Okay. And, when there's a disruption in supply and so on and so forth, I think we all understand this, but, this inflation was purely driven out of massive government overspending and handouts, right? Here's money for you guys to go spend, instead I'm going to get my blood pressure up.
Well, Chris, you mentioned that 2024 tax guide resource that you have. And what we're going to do, you're going to send that to me. We're going to make that available. We're going to link to it in the description of the program. So if you're a podcast listener, or if you are watching the video, check the description below and we'll have a link to that resource. You can also visit McIntireRetirementServices.com, McIntireRetirementServices.com if you're listening on the radio. McIntireRetirementServices.com has the central hub where you can find all of the resources that we discuss on the program. But this is a comprehensive guide to basically every aspect of what you need to know to plan effectively for the 2024 tax bill that you will ultimately have to reconcile and file at the completion of this year, but also insights into how to plan effectively for future years. So visit McIntireRetirementServices.com. You can find it there. And of course, linking to it in the description if you're listening on the podcast or watching the video. But bottom line, Chris, you may need to address tax and legislative risk now. Our national debt has swelled to more than $35 trillion. It might be 36 by the time I speak my next sentence. It's moving so fast. Congress passed trillions of dollars in additional spending. And these things could impact your retirement. We'll talk about quickly 4 different ways. Number one, changing tax brackets. Throughout history, tax brackets have changed. My assumption, Chris, is that they will change into the future and probably go up.
You're right. Yeah. When Ronald Reagan took office, the top income tax rate was 70%, and look at where we're at now. What's our top tax bracket right now is 37%. There are some additional excise taxes built in there for other things as well.
That being said, Chris, it has probably not been a mistake for the generation that is currently retiring to have deferred and delayed paying taxes when they were so high during the formative years of their career, right? That was probably a good move. It's just maybe time to change the paradigm and the way of thinking and start managing that tax bill.
Absolutely. And that's where we talk about, hey, should we be contributing or converting, right? Contributions or conversions into Roth IRAs where our future withdrawals will not be taxed whatsoever. So we're paying taxes now at lower rates and then to avoiding any taxation down the road. And also, Roth IRAs would pass on to your children income tax free as well. So, incredibly important. We're right now in that Roth conversion season as well, where we're working on that with current clients right now on what amount can they, I'll say, efficiently convert to a Roth IRA. Because remember, at age 73, you have your required minimum distributions. You cannot convert those funds into a Roth IRA. And many people need that money to live off of as well. And, that tax issue can be very complex, and, talking about it here on the show here, we're not here trying to point fingers at political parties. There's plenty of blame to go around on both of them. But both of the candidates out there right now have 2 different tax mindsets, I would say. I think President Trump, former President Trump, is talking about not taxing Social Security benefits. Okay. Well, when they do tax Social Security benefits, those dollars go back into the Social Security Trust Fund. So, they need to make an adjustment on, all right, well, how do we continue to keep Social Security on solid footing, Medicare on solid footing?
What if we don't trust the trust fund, right? And what if Social Security isn't so secure in and of itself? I know that is a concern, and that's where legislative risk comes into play, Chris, is that the government is in control of those kind of laws and regulations and how those programs are handled and funded. We trust them to do so, and it has not been run very efficiently. But looking at these 4 different ways that legislation from Washington could potentially impact your approach to retirement. Number 1, changing tax brackets. Chris, number 2, limiting tax deductions. And right now we have a very high, elevated level of standard deductions. That's the way most people are going, but that can go away and is slated to drop back down in 2026.
Yeah, for a married couple, the first $29,200 of income you have isn't taxed at all. So, they may say, hey, we're not going to increase your taxes, but we're going to reduce the standard deduction from 29,200 to 10,000. Okay. All right. That just means 19,200 more dollars of your income is taxable.
Yeah.
Right. Yeah. That technically they would probably say we're not increasing or raising your taxes. We're limiting your deduction. So, man, you just got to read, they're only lying when their lips are moving, guys.
Yeah, well, word salad, right? Doesn't necessarily mean what you think it means. Number 3 on the list, Chris, that you provided ahead of time here, adjusting which assets are taxed, right? And Social Security, one of those assets that has formerly not been taxable, now is taxable, and maybe they could change that into the future. And then the capital gains that you mentioned earlier is a hot debate right now.
Yeah. And, this is a funny area. A lot of people say, well, I already paid tax on that money once. Why am I paying tax on that money again? I said, you're not paying tax on it twice. It was withheld to pay you down the road. So that's their argument.
It wasn't a tax. They just held it for you.
Yeah, they just held it for you. Don't turn the radio off now. I'm on your side here because I pay both halves of that, and I have since I've been almost 26 years old. I've been self-employed. So my employers in my Social Security, I've got $8,000 of employer contributions. I have over $380,000 of my own money I've put into it. So when I talk about this, I'm passionate because I want to make sure I get my benefit. I'm concerned they will do some means testing, right? 2033 is 9 years from now,
I
you
mean,
know?
Chris, didn't they essentially do means testing? Isn't that what has essentially already happened? 1983, under the Reagan administration, they said if you make a certain amount of income, including the Social Security into the equation, then 50% of your Social Security income will be taxable. And then 1993, under the Clinton administration, they came back and said, well, that's not quite enough. So if you make even more than that, up to 85% of your Social Security will become taxable as income. That essentially, along with the IRMA, right, income related means assessment and adjustment on your Medicare premiums, these are means tested programs here, and retirement benefits, along with the fact that the tax code and brackets is already progressive, meaning the more income you have, the higher the tax rate that you pay.
Absolutely, Peter. And the tough part, or the bad thing on the Social Security benefits being taxable, is that money's never been indexed for inflation. So, the amount they're taxing in 1983 has not been indexed for inflation in 2024 terms. Okay. So, and again, to be fair here, yeah, Ronald Reagan was the president in 1983, but that party was not in control of Congress in 1983. And the same party that taxed it in 83 is the same party that taxed it in 1993 as well.
Well,
And do your homework and find out which one that is.
yeah. Number 4 on the list, these 4 different risks that could be impacted, or how retirement could be impacted by these 4 risks, rather, from Washington: tax risk and legislative risk, changing how assets are taxed, Chris. So for example, your IRA, right, is that a lot of people are worried about things like estate taxes. I've even heard conversations where people were worried about wealth confiscation. Oh no, the government's going to come and confiscate our money, like austerity measures like the country Cyprus had. I don't know, that was probably more than a decade ago now, during the Great Recession, where they sort of closed bank doors, and when they reopened them a week or so later, every citizen had a quarter to a third of their money just gone. But the reality of this is, Chris, they don't have to do that kind of thing. They can just incrementally raise income taxes, and essentially will accomplish the same thing, because by and large, the American public has not yet paid income tax on the retirement nest egg.
Yeah, and Peter, I get a fair amount of people that say, look, I'm concerned they're going to come in and seize part of my IRA or my 401k. And, that's typically not something I'd be really concerned about here in the United States. We have laws and whatnot that, certainly think they'd argue that up to the
But
Supreme.
quietly they do, right, Chris?
Yeah.
That's income tax. They do it already.
Yeah, you're absolutely right. So the manipulation behind the curtain, the great and powerful Oz, was just a regular guy, and that's what happens is, what goes on behind the scenes. What they say out in public in a 30-second news bite is different than what they say when they're in the meeting. I guarantee you that. And like Peter says, income tax rates are never made permanent. They've been as high as 70%, and even 90%, right? We didn't even have an income tax until we fought the Civil War, and now we're off the gold standard after we fought another war. So, the US has got some harsh realities to face. And just think how good the markets could be, the stock and bond markets, the strength of the dollar, if we could get somebody from each political party to come out, stand on a stage and say, look, we got some real problems, and we're going to have to address them together, instead of pitting one another against each other. We're Americans. We know how to do this.
Yeah. Well, if you are worried, ladies and gentlemen, about how Washington will impact your retirement, you are not alone, nor are these factors that should be ignored. Legislative risk and tax risk certainly can impact your retirement. You need to ask yourself these questions based on today's legislative environment. Are taxes likely to be lower, the same, or higher than they are today? How will your income be impacted if taxes are different than you expected. Have you saved enough for retirement, right? Are the vehicles that you are using exposing you to legislative risk or protecting you from it? And if you do plan to pass assets along to your heirs in the form of a legacy, are those protected from legislative risk? All of these, Chris, are part of your planning process. When you help somebody design their game plan for retirement, you're talking over these factors and making sure that they have addressed them.
Yeah, absolutely. And, we cut through the partisan stuff here. We don't care what party people belong to or whatnot. We have a fiduciary responsibility. We talk about the different types of risk, how they can impact their particular situation, the pension rollovers, all of those very important, critical decisions that sometimes you only get to make once. So, it's nice to be able to cut through the emotions and whatnot and help people make the best decision in their particular case, Peter.
Well, if you have questions, concerns, you would like to sit down, have a conversation, if you are an individual or family unit planning for retirement, as you have utilized and saved in your 401k or IRA, or even if you are a business owner looking to be more efficient with your business planning, cash flow, and reduction on expenses, particularly taxes, and reduce or address the risk of legislative change and tax law changes into the future, pick up the phone and give Chris McIntire a call. So many have utilized the services of McIntire Retirement Services, but so many more could benefit from doing so. 800-868-1194 is the number to call. That is 800-868-1194. 800-868-1194. Chris, always appreciate your time, sir. Thank you for being here on the program, providing some insight, discussing this sensitive but important topic.
Yeah, absolutely. Thanks, Peter. I hope you enjoyed the show, everybody. Stay safe out there. Thank you.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.